Anyone who has had their eyes on the recent news will be aware of the spiking interest rates that have been ravaging the economy lately. Yet not many people know for sure why this is happening, if this spike is going to last for long, if and how this is going to benefit anybody. As interest rate is the compensation or cost of borrowing, rising interest rates automatically reveal a high cost of borrowing. So far, the only underlying advantage people can pin on this rise is its ability to discourage people from borrowing loans. But even this is a two-edged sword aimed at the economy. That is, while people will no longer borrow money like before because it will now cost them more, it will cause them to start buying less. And buying less eventually will lead to low demand. Low demand means businesses will not grow at their former pace, and this will affect the economy on a larger scale. This rise in interest rates have even more severe effects on the economy than people tend to realize. At this point, it's no longer about reduced borrowing. Nevertheless, increased interest rates help stabilize an economy experiencing inflation, and the logic here is not too far-fetched. We already know that inflation is a factor of high demand because high demand creates consistent price increases. And when prices continue to go up as price demand increases, inflation happens. So, a system that attempts to curb inflation will spike interest rates, making it hard for the people to borrow money and, in extension, unable to purchase services and goods like before. As the demand drops continuously, so does price. And if there is no consistent price increase, inflation cannot happen. This is the part not everyone realizes. In a nation like the US, for instance, the Federal Reserve's main task is regulating monetary policy. What this means is, they control the money supply in the country. The Federal Reserve is the body with the most influence over interest rates, therefore has the ability to alter these rates in the US economy. And reports have it that the Federal Reserve has been consistently increasing interest rates in order to slow the economy down. In fact, it is reported that the Federal Reserve is trying to slow the economy down, raised interest rates by 200-point basis or 20% this year. This has affected both the day-to-day consumer and the housing sectors in no small way. After the Federal Reserve announced its third consecutive rate increase in September, Chairman Jerome Powell of the Federal Reserve came to the conclusion that higher interest rates had forced the housing market into a difficult correction that should bring it into balance after years of excessive demand and limited supply. Because of the higher rates caused by increased interest rates, demand for homes has really suffered. This is so as buyers, unlike before, are having to pay way higher than they used to in trying to get a mortgage, even on homes with the same price. What the National Association of Realtors have shown is this, that prices of homes have begun falling on a month-to-month basis. And this record shows that reduction of an average home that was worth $413,000 in June now fallen to $389,500 in August. Powell, speaking on this, said that the deceleration in housing prices that is currently being experienced should bring housing prices in line with rents and other housing market fundamentals. Powell told reporters after the Fed's September meeting that this indeed is a good thing. He contends that better supply and demand alignment is required in the long run in order for the housing prices to rise gradually and for people to once again be able to afford homes. What this aims to achieve is for demand to match housing inventory, which for many reasons has been limited. Powell, speaking from a business cycle perspective, said, "This difficult correction should put the housing market back into better balance. At the beginning of this year, it was still hard for buyers to buy homes. Yet, it was for a different reason entirely. In January, it was surprisingly competitive to buy homes when mortgage rates were near record lows. This was because prospective buyers were offering well beyond the asking price. Not only that, they were waiving inspections and assessment contingencies in order to get a chance at winning. Now that the mortgage rates are above 6%, this being the first time since 2008, the question here, which is also the problem, is how people can afford to buy houses at this rate. Shang Saavedra, personal finance blogger at Save My Sense LLC, said that the housing market is more likely to be moved satisfy demand. He said, "Where consumers like you and I are asking how we can afford a mortgage, and housing prices are seeming to be well increasing over time, what we want is for the mortgage to be more reasonable." But in an environment where the Fed raises rates just like they've done in the last few months, Shang continues to tell us that mortgages are becoming more and more unaffordable. And so, you're starting to see demand dropping off, home sales coming down, and rents going up. Founder and CEO of InstaMortgage, Shashank Shekhar, speaking on this issue, said that the Fed's rate hike would cause more difficulty for the housing market and increase the likelihood of a recession in the economy at large. He explained that while this will slow inflation, it does point to a further slowdown in the housing market as more homeowners will find themselves disincentivized to refinance and potential home buyers will find it unaffordable to buy. According to him, the question of whether the economy is headed toward a recession is more important and is becoming more of a when than if debate among market commentators. Yet with all this horror, there is still light at the end of the tunnel for homebuyers. As while it is true that mortgage rates are more difficult to afford now than before, the reduced demand has created space for lesser competition. Odeta Kushi, an economist at First American Financial Corp, explained this further when he said the housing market is currently rebalancing. The effect of this, according to him, is that we're now facing a situation where mortgages are significantly higher than they were a year ago. He added that house prices are decelerating, as we can see. You might enter a market where you don't see the budding wars that we saw last year. You're not competing against 5 other people, Kushi said. We will not fail to mention that as interest rates are rising, foreclosure rates are also on the rise. By definition, foreclosure is the legal process through which lenders can collect the amount owing on a defaulted loan by seizing and selling the mortgage property. So, increasing interest rate means lenders now have to pay higher to break even. According to a report from Atom Data Solution, foreclosures are said to be rising sharply after federal pandemic protections ended. Last year, as the government and private sector policies designed to help homeowners deal with the economic fallout of COVID began to expire, foreclosures started to fall. Same last year in the third quarter, mortgage lenders began the foreclosure process on 25,209 participants, which was a splitting 32% rise from the second quarter. Adam calculates that it has been a 67% rise on a year-over-year basis. Borrowers who were experiencing financial difficulties were able to postpone their monthly payments for up to 18 months, thanks to the government and private sector assistance initiatives. The unpaid balance would then be added to the remaining loan balance, to be paid back when the house was sold or the mortgage was refinanced, or both. New York, California, Illinois, Texas, and Florida were the cities with the largest number of new foreclosures. Rich Sharga, the executive vice president at RealtyTrack, which is an Atom company, said despite the increased level of foreclosure activity in September, we're still far below historically normal number. In September last year, foreclosure activities were nearly 70%, lower than they were before the pandemic. Sharga said that even if the increase is only a window to bigger issues or a return to normal level, foreclosure is obviously one of the biggest topics of debate at the moment. In February this year alone, over 25,000 properties in the US were subjected to a foreclosure filing. This value is over the 11% increase in January, which altogether is 129% increase in 12 months. Reports have come from experts at Atom saying that these double-digit increases are predicted to consistently rise, although the COVID-19 foreclosure moratorium reduced these numbers, making the foreclosure market much more stabilized. The rising inflation could change all of that. Bankruptcies are also an effect of this rise in interest rate that we have so far discussed. At the beginning of this video, we talked about how Federal Reserve raises the interest rate in order to combat inflation. What we did not mention is how it can lead to bankruptcy in companies and private-owned organizations. According to recent data, approximately 80,000 enterprises would have trouble adjusting to a 0.25% increase in the existing interest rate. In addition, if interest rates were to rise, it is estimated that 79,000 enterprises would be unable unable to pay their loans back. Additionally, according to data which was presented by the insolvency body R3, the number of businesses that are now in danger of going out of business or being insolvent has increased by a factor of 4. There are undoubtedly a sizable number of zombie businesses that are having trouble making their payments. A zombie business is one that is still operating solely because of generous creditors and cheap interest rates, despite the fact that it is too weak to invest or expand. Additionally, a large number of businesses have been discovered to just be paying the interest on their loans. On a wider scale, the Bank for International Settlements, BIS, has given a forewarning that the global shadow banking sector may see a string of bankruptcies as a result of interest rate increases from central banks around the world. Claudio Borio, director of the BIS's Monetary and Economic Division, said in an interview with The Times that shadow banks, such as hedge funds, pension funds, and private equity companies, are currently experiencing a liquidity shortage that first appeared in March 2020. This rise in interest rates seemed to be causing more harm than good. Will the economy recover from this rise? Where is the inflation heading to? What will the Federal Reserve do about all of this?